This is the second part of my Ford investment case review. After discussing in very much detail in part 1 Ford's performance, in this part we talk about valuation and implied share price. Here on this first chart you see the key input for valuation analysis. There are other metrics we could use, but this metric is the most useful for share price projection. So you're looking at earnings per share diluted. Importantly, this is shown on a non-GAAP, aka adjusted basis. So Ford just reported second quarter results. The company reported 37 cents per share. This implies a almost 22% year-on-year decrease. First quarter was down 72%. And current outlook for 2025 implies a 36% year-on-year decrease. I'm using for 2025 and 2026 consensus estimates. And I use a very aggressive extrapolation after the year 2026. And you can see what the assumption is down here. So let's start first with 2025. So consensus expects a 36% decline after a really bad first half of 2025. And as we discussed in part 1, quite lackluster management guidance for 2025. Then consensus currently expects a almost 20% year-on-year increase and expects Ford's adjusted earnings to come in at $1.41 per share. Very simplistically, I'm assuming in this analysis, this recovery in Ford's earnings continues in 2027, 28, and 2029, each year at that almost 20% year-on-year growth rate, which implies that we get in 2028 back to roughly the level Ford was at in 2023. So in 2023, the company reported $2.03 per share. And the forecasting you're looking at implies $2.01 per share in 2028. I'd like to point out that 2023 was a very strong year for Ford, because there were a number of significant one-off global automotive industry drivers that drove a lot of windfall profits. And Ford was one of them. I covered the reasons previously, so I will not cover them here again. But in short, all automakers that were oversupplied before COVID could monetize this oversupply at very high margins, so it was a godsend. Or in other words, anyone who couldn't sell enough vehicles and had therefore too much supply could harvest huge windfall profits. And Ford was amongst that group. Globally, the two top winners of that situation were probably General Motors and Stellantis. So the next step is that we have to turn these quarterly EPSs into next 12 months metrics. So next 12 months just means from a certain point in time, we just add up the next 4 unreported quarters to create an annual number. So this is what this chart does. It's effectively exactly the same chart you just looked at, but from so down here in the axis you see May, July, October, February. These are the months in which Ford reports the quarter that just closed prior to each month. And the number that is shown for each month is in that month after Ford reported the then next 12 months. So for example, here let's pick July 2025. The next 12 months EPS is $1.32. If you go back to the quarterly number, that $1.32 is the sum of the next unreported quarters. That's Q3, 35 cents, plus 32 cents, fourth quarter, plus 31 cents, first quarter of next year, and plus 34 cents, second quarter of 2026. So you add this up, it gets you to $1.32. Now we go back to the next 12 months chart, and you do this analogously for all the other quarters, and that creates this, let's call it rolling forward next 4 months. But for a share price corridor, because we don't want to do it just for every quarter once, we need a continuous earnings stream for every trading day. Because if we don't do it, we have, and this is what this chart, this funny looking chart shows, you have these thin bars. So on a given reporting date, you have a next 12 months metric. So we change it into a continuous metric. And what we do, if you look between these two earnings dates, we just extrapolate linearly from this point to that point. Alternatively, a simpler approach, what you can do is you just keep that next 12 months metric constant for all trading days until the next quarter is reported. This is exactly what this chart does. So you can see it creates this staircase pattern. The value is held constant until the next reporting date, and that creates this flat line between each reporting date. But as I explained in another video, and there's a superior approach, and this is what I briefly touched on before. We don't keep it constant. We linearly extrapolate. That has various benefits and basically no downside. There's a small refinement and gives you slightly better or more accurate multiples, in my opinion. The result looks like that, and when you compare the staircase, the result is relatively similar. And this is more useful for the next step, which is to infer a implied share price. But before we can do so, we need a multiple, and therefore we need to look at Ford's trading range. And you can see on this chart, this is so for the last 5 years, the next 12 months multiple or forward 12 months PE multiple is all the same names. And this black line is based on the last 12 months, so not this entire period that you see here. And this black line is the median forward multiple. Just a quick recap: what the median is, if you lined up all multiples over the last 12 months in order from high to low or from low to high, doesn't matter, and you pick the multiple that is exactly in the middle of this line, that's the median. The beauty of the median is that the very high outliers or very low outliers, they would be at the beginning or at the end of this lining up. And because you pick the center value, they do not affect the metric. While if you just took the average, large outliers, for example, very high multiples, they would pull up the multiple, and the opposite was true for very low multiples. For that reason, in general, I prefer using median. So what does the data show us? Here in the bullets, you can see the outcomes. So the median is 8.0 over the last 12 months. Currently, as of the closing price on 1st of August, at time of this recording, that's the last closing price. Ford's implied 12 months forward P based on consensus estimates is 8.2 times. This came down from just under 9 times very recently. The green and red lines respectively reflect the 1 times and 1.5 times standard deviation. So the 1 time standard deviation reflects a normal trading range because it's an event that occurs quite frequently, while between the red and between the green and the red lines, this is a more outlier scenario. As you can see, it does happen, but not that often. And then once the multiple gets outside the range implied by the red line, it becomes quite an outlier scenario based on the trading level that we can observe over the last 12 months. So also over this last 5-year period, there are a couple of interesting observations. COVID hit in the first quarter of 2020. There was a significant sell-off in the market. There were shutdowns and various other things, and this significantly depressed the Ford share price. That would have been a great buying opportunity, just like it was for many other stocks, because at that time, everybody thought the world would end. Huge recession didn't happen. Huge money pumping globally prevented all of that, and caused a significant spike in share prices. This then drove kind of a bubble in the global equities markets, and this also affected Ford share price, which also benefited from improved financial performance due to people receiving government checks, very strong auto prices due to scarcity and other things. And that drove Ford's multiple up to a long-term high of just under 14 times, which is quite expensive for effectively what is a no-growth company, as we discussed in part 1, and very low profitability company. Shareholders apparently ignored all the obvious signs, but we covered this in part 1. And then obviously after inflation kicked in, Fed raised interest rates, etc., share price quickly deflated and dropped to the level before COVID. And then so between June 2022 and around, let's call it February 2024, for around 1.5 years, stock most of the time bounced around 6 times multiples, are not very exciting, with the occasional rally. For example, in summer 2023, there would have been an amazing short opportunity. Stock then quickly sold off. Sorry, I misspoke. The stock rallied in the summer of 2023 outside its normal trading range, touched over 9 times again, but then quickly lost the trading level, and then slowly recovered. And then for the last year, bounced around the 8 times multiple as we discussed, the median multiple, and then briefly crossed into the 10. So the big picture is Ford typically trades at very low multiples and has been for quite some time in a fairly narrow range, within approximately half a multiple around the 8 times multiple. So this next chart is the same chart again, just zoomed in a bit more so that we can see more clearly the implied trading ranges. So please pause if you want to study this more. This is yet again the same chart, just zoomed in a bit more. This is now the last 12 months for which the black line, the green line, and the red line calculate their respective values. This is the considered time period for the trading level. And you can see how most of the time, when you look at the green lines, green line is almost exactly at 1.85 at the high, and the green line is at the low just over 7.5 times, and the median is almost exactly at 8 times. You can see that in this very narrow range, this is the most frequently occurring trading range. Just recently, as part of a strong overall stock market, stock traded up into earnings. Ford just reported last week, but then stocks sold off on earnings, plus there were negative news, market news around tariffs, created market-wide pressure, and this then quickly drove the stock down and resulted in a lower multiple. So the key takeaway from this chart is that once the stock gets to a 9 times multiple, it tends to be a good short opportunity. And it's a good short opportunity because when you look at the long-term trend, the multiple appears to be quite limited in range. And it's quite unlikely that the stock would then continue on to trade at 10 times, 11 times, 12 times multiple. But of course, that requires that you have an accurate estimate of Ford's future earnings. So now with that, we have all the ingredients we need to create a share price corridor from these data points. So this is what this chart shows you. So keep in mind, 2025, 2026, unreported is based on consensus, and beyond, so the years 2027, 8, 29, is based on aggressive year-on-year 20% earnings growth. So the net result is that the forecast implies, based on the last 12 months trading level, that the stock would likely trade up to around $12 per share. That would be around 14% upside over the next 12 months, and then could add another, or from today's perspective, over the next 2 years, could add 36% to around $15. And you can see, again, this chart, this corridor is based on the last 12 months trading level, the median and implied standard deviations. And for this reason, it fits quite well for more recent time periods, so let's say over the last 2 years. But then when you go back further in time, you can see that the corridor is much higher than was actually delivered, and this shows you this, let's call it depressed trading level Ford and other automakers had after the COVID effects. But it shows you that the market actually accurately assessed the potential of these stocks, because the stock price is lower than what the corridor that today's, I have to rephrase this, so based on today's knowledge of later actually delivered earnings and today's multiple level, the market at the time did not believe that Ford could sustain that level of earnings, and this is actually what later happened. So that's why I always find this quite interesting when you compare this corridor that is based on today's knowledge and actually delivered earnings with the actual share price, because it allows you to see the discrepancy in valuation levels. I mean, you can see it in the multiple directly, but I think this adds another level of detail or a granularity. So let's zoom a bit. Let's zoom in a bit. So as mentioned previously, recently the stock got out of its implied trading range. So there would have been a quite a quick win short opportunity. Again, it's not trading advice. You have to make your own decisions. Then around March, as part of the market-wide sell-off, I mean, you could have bought pretty much anything and you would have done well. There would have been a buying opportunity. And last year, here it's hard to see. This was around early August, end of June, early August. On 5th of August last year, there was this kind of mini market crash we had as part of the Japanese carry trade unwind. And this coincided with some other negatives around Ford, and this created this crash in the multiple. So the long story short, even though Ford is not a super exciting stock, It doesn't have any realistic AI angle. It doesn't have any meme stock potential. Most retail investors couldn't care less about Ford. I think as part of a risk diversified portfolio that still is seeking to generate alpha, the occasional crazy runs or troughs in Ford could be used as some extra return, especially if there's some potential catalyst coming up. And the potential catalyst in this case is in 1 week. Ford is going to unveil some new EV product. We don't know yet what exactly that they're going to unveil, but and in part 1 I talked about my expectation already. And depending on what they present and how the share price reacts, this could open up a potential short-term trading opportunity. And I always look at these things both ways. If something is completely oversold, I might take a long position. If something is overhyped in my view on something that is not material, and I take a short position. For example, very recently there was this huge over 40% run in Lucid spike. I knew, or I'm quite confident, this is a non-material news item. It was on the announcement of the Uber partnership. And in such a situation, because I know the company inside out, I can quickly take a view, take a short, and just wait for the knife to drop. And this is in general how I would recommend you go about investing. Learn as much as you can about a company, but be prepared that this knowledge might not be immediately actionable. You should think about it more like you learn something and you put it into your arsenal. And then depending on whether a news item or a crazy share price movement happens or not, you act accordingly. Don't be like, okay, I studied this company, I have now all this knowledge, and now I should act, I should buy or short. No, study the trading ranges. Yes, you might be able to do it right away, but sometimes you just better sit on your knowledge, observe the stock, and if something happens to the up or downside, you react accordingly. So for example, when it comes to Ford, what I'm going to do is I will be monitoring the stock. Should it get out of range, I will send a trading alert to my subscribers on X, but I only do it when I also act on my own, not trading advice. Because I always invest with skin in the game. Because I'm not an influencer or a content creator, I'm investor first of all. So that's the end of my 2-part Ford series. I hope this was helpful. Thank you very much for listening. See you in the next one. Thanks. Bye.